Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. My name is CPA Makan, and today I will be taking you through revision, financial management, sitting April 2025. So the most current sitting from CASNEP. So I'll be taking you through all the questions right away from question 1 to question 5, and specifically on computation. So therefore, I welcome you and enjoy the lesson from the beginning to the end. I have one request. One request is that if you have not subscribed to my YouTube, kindly I request you to subscribe so that you'll be able to get my notices on time and also be able to learn more and more about CASNEP. Number two is that we have those who have subscribed but have not put their notification bells on. I request that you may able to put your notification bell on so that you'll be able to note when the videos are ready. So therefore, I would like you to now begin with me this particular revision. That is what I've written already on the board. Financial management revision April 2025 sitting. So this one is very important for those who are going to sit for the exams in August. So therefore, I'm going to take you through revision right away from question 1 to the last, and specifically on computation. Welcome and enjoy revision. Yes, I go to question 1B. Question 1B. Now, what is very important is you to note what are the main areas that we need to understand when it comes to any computation question. So from this particular question, that is question 1B, it has been actually tested from capital, cost of capital, and therefore we want to see what are the main points that we need to know about the cost of capital. Now, the question reads, Pivot Limited is considering raising an additional 20 million shillings to finance an expansion program. The firm's existing capital structure, which is considered to be optimal, is as follows. So you can see that optimal capital structure that is given there. That is ordinary share capital, 100,000, reserves, 50,000, 16% debentures into brackets 1,000 shillings per value, 62,500, 14% preference shares capital, 20 shillings per value, 37,500. Total capital structure given there is 250 million. Additional information: 1. The firm expects to generate 4 million from retained earnings for this expansion program. 2. Additional new ordinary shares will be issued at 90 shillings each, subject to flotation cost of 10 shillings per share. The most recent dividend paid by the company is 4 shillings per share. The firm's dividends are expected to grow at the rate of 5% per annum in perpetuity. 3. The company will issue new 16% debentures at a price of 1,100 shillings with a flotation cost of 5 shillings per debenture. 4. New 14% preference shares will be issued at 30 shillings with a flotation cost of 2 shillings per share. 5. Corporation tax rate applicable is 30%. So therefore, this question is very important, and therefore it is testing on some areas. For example, they are saying required number 1, the cost of required, the cost of retained earnings. Roman 2, the cost of new ordinary shares capital. Roman 3, the cost of new 16% debentures. Roman 4, the cost of new preference shares. And Roman 5, the company's weighted marginal cost of capital. First, before I move on, let me first of all explain what it means by the question Roman 5. You are required to calculate the company's weighted marginal cost of capital. When you talk about marginal cost of capital, we are talking about additional cost of capital that the organization wants to raise. From this particular question, we have been told that the organization or the firm wants to raise 20 million. So that additional 20 million is exactly what is called marginal cost of capital. And in this case, we are calling it weighted because we are going to split, whereby we need to calculate the cost of capital per existing per existing capital structure. Remember, there is a difference between weighted average cost of capital and weighted marginal cost of capital. When you talk about weighted marginal cost of capital, we are talking about additional cost of capital. But when you talk about weighted average cost of capital, that is WACC, we are talking about the average cost of the existing capital. But in this case, you are focusing on weighted additional capital. So let's now see. First and foremost, you have actually been asked to calculate information. For example, Roman 1. Here you have been told you are required to calculate the cost of retained earnings. So let me represent the cost of retained earnings by letter KR to stand for the cost of retained earnings. And the formula says for us to calculate the cost of retained earnings, we need to take the current dividends that have just been declared and paid and into 1 plus G divided by market value in this case, then you have to add G. So this is actually our formula that we normally use to calculate the cost of retained earnings. We take the dividends that has just been paid now, then we grow it at this particular rate, that is G, then we divide everything by P0, which is the market price, then we add the growth. Now in this case also, D into brackets 1 plus G means it is like the dividends after 1 year. And the dividends after 1 year is written as D1 over P0 plus G. Therefore, it means that our formula can be simplified by saying D1 over P0 plus G, whereby D1 is the dividends after 1 year, which means we have grown it after 1 year. For instance, when you go to our previous videos about the time value of money, you will find that this particular formula has been, I've explained this formula widely. Secondly, this particular D1, you have to be very careful. And therefore, let's reread the question, that is additional information number 2. That is where we want to know whether we are going to grow the 4 shillings per dividend or we are not going to grow 4 shillings per dividend. We only grow 4 shillings per dividend if it will be paid, if it is paid at the beginning of the year. But if the question says it will be paid at the end of the year, it means that that is D1. Correct? So that is D1. But in this case, they are saying it has just been paid recently. It says that is additional information number 2. The most recent dividend paid by the company is for a most recent. So therefore that is D0. Therefore we need to grow. In this case now, it will be 4%, 4 shillings into 1. It is growing at the rate of 5%. So it will be now 1 plus G, which is growth of 0.05, which will give me now 0.05 over market price. In this case, we have been told it is 90 shillings. Then we add 0.05. So if you press your calculator very well, your answer you are supposed to get from that particular question is 9.67%. So you'll have already your 2 marks. Roman 2 says calculate the cost of new ordinary share. So for the cost of new ordinary share, let me just represent it with the letter KE to represent the cost of what? Equity. Although I know that when you talk about the cost of equity, or this word equity here, we are referring to both ordinary shares and retained earnings. But for this particular case, kindly, let's just say E to represent the cost of ordinary shares. So that now, when we shall be having this and the one we shall be calculating here, we need just to combine so that we can now get one cost of equity. So for this case, I've separated cost of retained earnings and I'm also separating cost of equity. In this case, I'm calling it cost of ordinary shares, which is given by D0 into brackets 1 plus G over P minus F plus G. I want you to take note of this. When you are calculating the cost of retained earnings, there is no any additional cost that would incur because you have already retained earnings with you. So therefore, you just get money from your bank and use automatically. But when it comes to ordinary shares, you will incur some additional cost of maybe doing advertisement, pre-printing the prospectus, and also maybe legalizing the documents, that is contract, and involving the lawyers and also the accountants. Those additional costs is what you call flotation. So the flotation cost does not affect the retained earnings. That is why you have seen here I've just written P0. But when it comes to ordinary shares, because I will be issuing, I will be incurring additional cost. So that is the only difference between the cost of retained earnings and the cost of ordinary shares. So in this case, it will now remain D1 over P0 minus F plus G. And in this case, we have discovered that this D1 is growing. So therefore, it will be this one. So therefore, it will be 4 into brackets 1.05 divided by 90. We have been told there will be a flotation cost of 10 shillings per share. So that flotation cost will automatically reduce the market price. So we'll reduce the market price by 10. Okay? Then from there, we now retain our growth. And when you press your calculator very well, your answer you're supposed to get is 10.23%. Roman 3. Roman 3 says calculate the cost of preference shares. So the cost of preference share class, let me represent it by KP equals to DPS over market price of the preference shares. And this market price of preference shares, when you will be issuing also, you will be incurring the additional cost. So therefore, you will still be affecting what? Flotation. And remember, in this case now, we don't have any growth because these preference shares behave in a way that we normally call it hybrid capital. Hybrid capital means that this is a capital that can either be ordinary shares, can be either be owned by the organization, or can behave like a debt. So in this case, these preference shares behave like a debt, or can also behave as what? Ordinary shares. For that case, it will be like that. For that matter. Therefore, it means that the dividends paid to the preference shareholders will be constant. So there will be no any growth. Growth only comes in when you are referring to retained earnings and ordinary shares. So therefore, in this case now we say equals to. Now, where is our cost of capital? We have been told from the question, ordinary, go to the capital structure. Ordinary shares there that are saying it's 14% preference shares, capital into brackets 20%, 20 shillings per share. So 14%, here it will be 14% of the preference share per the preference share, the cost of preference share at par value. So in this case, it will be 20 shillings. Don't use the market price. When we are calculating the dividends, we normally calculate the dividends using the par value. So in this case, the par value is 20, not 24. 24 is the market price of the preference shares. So we divide this one by the market price. In this case, we have been told that is an additional information number 4. Market price is 30 shillings, but there is a flotation cost of 2 shillings. So when you work out this one, you will get 2.8 divided by 28. And when you now work out this one using your calculator, your answer you get there is 10%. Roman 4. Roman 4 there is asking us to calculate cost of debentures. Cost of debenture, D for debenture. So, class, when you talk about debenture, then we normally have two formulas. The first formula is where we don't have any maturity period. And the second formula is when we have the maturity. The one that we have the maturity is what we call yield to maturity. But in this case now, from this particular question, it means that the debentures will be there into perpetuity. Therefore, there will be no period of expiry. And for that matter, our dividend, our formula will be now interest into brackets 1 minus t over the value of the debt. And this value of the debt is also affected by what? Flotation. So this formula here will be used to calculate the cost of dividends if the debentures used to secure funds will go into perpetuity. But if there is any maturity, for that matter, this formula will change. We shall now use the formula which says int interest into brackets 1 minus t. You say plus into brackets the nominal value, then you minus the value of the debt at the moment, then you put it over n, everything over m plus value of the debt, then you get the average. So m here stands for the nominal value of the debenture. Then VD is the value of the debenture. That means the market price. Then you multiply by the reciprocal of the maturity period. So from this question as it is, it doesn't have any period. Therefore, this is our formula. Then we go to our interest. What is our interest, class? Our interest will be automatically the par value of the debt collected. In this case, we have been told it will be 16% of the par debenture, not the market price. It will be 16% of the par debenture, which is what? 100, which is 1,000. Then this 1,000 here, we have to pay the tax. In this case, it will be 1 minus t tax. Then everything over the value of the debt. In this case, the value of the debenture we have been told is 1,100. Out of this 1,100, there will be what we call 5% flotation. So we minus 5 shillings flotation cost. So what will be your answer? So for the case of T, we put 30%, which can be 0.3. So when you press your calculator, in this case now, if you press your calculator very well, you will get 112 over 1095, which will give you 10.23. 10.23. 10.23. That is for debenture. What about the cost of equity? The cost of equity, sorry, it will be 10.5. This one, sorry, 10.25. If you press your calculator, you get 10.25. Now, the last question now there is, that is number 5, calculate the weighted marginal cost of capital. And you can see, weighted marginal cost of capital is carrying more marks. That is around 6%, meaning there is a lot of work. For each of these, you are only supposed to calculate each of these was carrying actually 2 marks. But here, there is a lot that you need to do. First, you need to write your formula down by saying, I know my weighted marginal cost of capital is given by weight of equity, okay, times its cost of equity, and plus weight of retained earnings times the cost of retained earnings. You add weight of the debt times its what? Cost of debt, and you also say plus weight of preference share times the cost of preference share. In this case now, look at this class. We have already KE, KR, KD, and KP already calculated here. What is missing are the weights. And what are the weights? Weights means proportions. And there are 2 ways in which you can calculate proportions. Number 1, you can use what you call the book value. Book value here, we mean the values of this capital structure as displayed on the balance sheet. That is number 1. Number 2, you can also calculate the weights by use of the market price. So it depends with the question. If the question says use the book value, which means use the existing capital structure to calculate the weights, which means WE, WR, WD, and WP. If you have been told to use the market price, then that means you have to convert everything into market price. And for this case, because you have not been told, then our simplest way to answer this question is to use the existing capital structure. And therefore, for the existing capital structure, you have been given already the cost of the ordinary shares from the question. We have the ordinary share capital, which we have been told to be 100,000. We have the reserves plus, when you talk about reserves, you are still talking about retained earnings. So this one is 50,000. And then we have what we call the 16% debentures, which is giving us 62,500. Then we have 14% preference share capital of 37,500. Total 2,550. The class, this is the total. I want to get the weights. What is the proportion of ordinary shares in the total capital structure? What is the proportion of reserves in the capital structure? What is the proportion of debentures in the capital structure? And what is the preference share capital in the capital structure? In this case, now it will be 100,000 divided by 250. So it will be 100,000 divided by 250,000. Then this one will be 50,000 divided by 250,000 to get the proportion. This one is 62,500 divided by 250,000. Then this one is 37,500 divided by 250,000. So the proportion here is, this one will give you 0.4, is 0.2, this one will give you that is 62, it will give you 0.25, 0.25, and the last one will give you 0.15. So what is this class? This is our proportion, this is our weights by use of what? Book value. So you should state it clearly by saying using book value. You should state to that examiner that you are using the book value. Now once you have this one, it means that automatically I have now the weights here. I have already the weights. But what is the question saying? What the question is saying, marginal cost of, which means the additional cost of capital. So therefore, the company wants to raise 20 million, not the 250. So this 250 here is helping us to calculate the weights. Once we calculate these weights here, we need now to use this weight to distribute or to analyze and find out how much can we get, how much can we issue for us to get the ordinary shares from the 20 million. So there is some work need to be done again. From here, because I have the weights here, I will multiply this one by, it means the 0.4% of the ordinary shares will be issued to the public to collect some amount of money. And that amount of money is from 20 million. So the additional 20 million will come from here. So you will take now 0.45 times the amount of money you want to raise. So in this case, I will multiply by 20 million. Correct? Even this one I will multiply by 20 million because that is the additional amount of money I want to raise. I will multiply by 20 million and also multiply here by 20 million. So what will be my amount of money I will raise by issuing the ordinary shares? I will raise, already for the reserve or retained earnings we have been given to be 4 million. We want to prove whether it is true, it will give us 4 million here. So let's see. This times this you get 8 million. This times this is 4 million. You can see from the question we had already been given this 4 million here. So ours is just to prove that. Then this times this you get 5 million. And this times this you get 3 million. So when you try to add this, your answer you get is 20 what? Million. So in this case, we were not asked to calculate the weighted average cost of capital, WACC. No, we have been asked to calculate marginal cost of capital. So therefore, instead of us stopping here, we will now use this one to calculate the correct weights. Therefore, if I want to get the weight for ordinary share capital, I will take 8 million divided by the total. Reserves, I will take 4 over 20 million. For the debentures, I will take 5 over 20 million. Then for the preference shares, I will take 8 over 20 million. So for me to get the proportion here. So therefore, my final answer now is weighted marginal cost of capital is equals to weight for the equity, which is this one now, 8 over 20. 8 over 20 multiplied by the cost of equity. So I'll just pick it from here as 10.25% plus weight of retained earnings, which is 4 over 20 times 9.67% plus weight of debentures. In this case, it will be 5 over 20 times the cost of debenture. In this case, it will be 10.23% plus, then I go to weight for preference is 3 over 20 multiplied by the cost of preference shares. In this case, it is 10%. So if you press your calculator very well here, the answer you get there is marginal cost of capital is 10.022 or 10.22%. The answer is 10.22%. You can see how simple it is. So this is weighted marginal cost of capital, not weighted average cost of capital. So we go to example 2. Go to example 2. We go to example 2. Yes, we go to example 2. Example 2 there, that is question 2b. Question 2b. So question 2b reads, Montage Limited's ordinary shares are currently trading at the security exchange at 30 shillings each. The firm is considering raising additional capital to finance an expansion program. The board of directors has proposed to raise the funds using a rights issue. Automatically you know what it means by rights issue. The expansion program is expected to cost 5 million. This investment will generate additional net operating cash flows of 1,700,000 each year for a period of 5 years. This information has not been released but shall be released upon announcement of the rights issue. The firm has in issue 2 million ordinary shares. The cost of capital is 12%. Required, calculate the CAM right market price per share of the company. First, I want us to understand what is the meaning of the word CAM right market price, or just the word CAM right. When you talk about a CAM right, here we are talking about a right to get dividends. So this is the payment of dividends. This is the payment of dividends when you have already the rights. For example, if you buy some shares in one of the companies, correct? Maybe you buy the shares in the course of the year. You do not buy the shares at the beginning of the year, but you buy them in the course of the year. Immediately you buy the shares in the course of the year, automatically it means that you also get the rights to get the dividends at the end of that particular year. The dividends that you are guaranteed to get at the end of that particular year is what they call CAM rights. These are rights that you enjoy as a new member based on what the other existing members have been enjoying. So you automatically get the rights to enjoy the shares. So in this case, they are saying when they will be issuance of this particular rights issue, automatically you get the rights to the dividends. So when you say come dividends, you are just talking about the payment of dividends at the end of the period, or a guaranteed of dividends at the end of the period. And therefore, we have also been told in that particular question, calculate the come right market price. So we now say, okay, come, sorry, don't know what is the problem with this. Come rights market price per share. That's what they are saying. Come right market price per share. When you talk about market price here per share, it means that you are getting the market value of the entire shares that you have, then you divide by the total number of ordinary shares that you have. That is what it means here. You take the value of the firm, divide by the total number of shares. In this case now, we want to include the come rights here, which means the rights from the from issuance of this particular rights issue. So we want to find what is the value of the rights issue, so that we add to the market value of the market value of our firm now as we speak. So in this case, our work is very simple. Imagine you have just been given your 4 marks for free. So your work is very simple. In this case, you now say the answer here should be total value divide by total shares. Total what? Shares. Now, once we have done that, we need now to understand every part of the question. They are saying Montage Limited's ordinary shares are currently trading at the security exchange at 30 shillings each. That means that is a market price per share. Per share, sorry. Now, for that case, let's get the market value at the moment. So we now say market value equals to 2 million ordinary shares that we have at the moment, multiply by 30 shillings. You get now how much? 60 million. This one here is without the rights issue. So without rights issue. Then we have also been told on the same note that the expansion program is expected to cost 5 million. In this case, this expansion, this 5 million is our cost when we issue what? Which means the company will give out 5 million because of the rights issue. Therefore, the question here is how many rights issue will be issued? Therefore, they will be issued at what price? 30 shillings. So therefore, for me to find out the number of ordinary shares on the rights issue will be now, and rights, so you can say number of rights issue is now 5 million. You divide by 30 shillings. You get 166,667 shares. Correct? Then it continues by saying, this investment, if we invest the 5 million, what will happen? The 5 million shillings. This investment will generate additional net operating cash flows of 1,700,000 each year for a period of 5 years. So therefore, we have been told that when we invest these 5 million shares, 5 million rights issue, we are able to generate 1,700,000 per year. For how many years? 5 years. So therefore, we need to find out the present value of that amount after 5 years. Then we need now to find out the net present value, the profit. Is there a profit? So for us to calculate the profit, in this case now, we call it net present value is given by present value cash inflow minus present value cash outflow. So present value cash inflow is now your 1,700,000. Okay? In this case, you are multiplying by the factor. In this case, I told you when you go back to my previous videos, you find that I've written 1 minus into bracket 1 plus r power negative n over r. This one here will give you what? That one will give you your discounting factor. Once you multiply this discounting factor by this, then you minus now your the present value cash inflow. In this case, it is 5 million, like that. Correct? So if you now press your calculator very well here, it will give you, that means you say now 1 minus into brackets 1,700,000 into times 1 minus 1 point r. What is the value of r in from the question, class? What is the value of r from the question? 12. So 1.12 power negative 5. You divide everything by 0.15 minus 5 million. So let me go slowly because it is very important. Now this one will give you 1,700,000, and if you press this correctly, your answer you get there is 3.605. Then you minus 5 million. So your final answer there is 1,128,500. So remember, this is our formula. Total value divided by total shares. So I have already the value for shares, which is 60 million. Where is it? Here. I want to find out now. I have also another amount of money I'm getting when I incur a cost of 5 million. So it will give me a profit of 1,128,500. So what will be my total value here now? It will be 60 million plus 1,128,500 divided by the total number of shares, which is now rights issue 166, 676 plus the 2 million here. So therefore, my CAM value will be 60 million plus this one will give you 61,128,500 divided by the total shares, 2 million plus 166,667. Your answer there is 2,166,667. So if you divide this answer here, your correct answer should be 28.22 shillings. So that is how you are supposed to score your 4 marks without any problem. Correct, class? Good. Good. Revision is very sweet. Financial management is very easy. It's not hard. We go to question 2C. Question 2C there, sorry, says, the following information relates to two securities, security X and security Y, where an investor has a capital of 1,500,000, in which 900,000 is to be invested in security X, while 600,000 is to be invested in security Y. So you have been given that table there. We have the economic states, that is A, B, C. We have the probabilities there. We have security X, returns for security X, and returns for security Y. Required Roman 1, expected portfolio returns, 4 marks. Roman 2, using the mathematical model, compute the portfolio risk. You have to understand those terms very carefully. A student who has been studying notes carefully should be able to know what they mean. Now, the first one says expected portfolio returns. In this case, when you go back to our notes, expected returns portfolio means this is the group of assets. So therefore, we need to get the weighted average. The weighted average for the returns. Then they are saying, using the mathematical model, compute the portfolio risk. When you go to our notes, how do you calculate the portfolio risk, class? Portfolio risk is calculated by getting the weighted average of the standard deviation. So it is very direct from our notes also. Now let's see. Now, Roman 1. I don't know what is the problem with my pen today. Roman 1. So Roman 1, we have been told you are expected to calculate expected portfolio returns. Portfolio returns. So portfolio returns in this is the weighted average of expected return. So you can say it is the weighted average. Weighted average. And what is the meaning of the word weighted average? It means you are adding. So in this case, we will take the weighted average for security X and that of security Y. So our work will be very simple. Therefore, this one means you take the weight of X times expected returns of X plus the weight of Y plus times the expected returns of Y. Weight of X times the expected returns of X plus weight of Y times the expected returns of Y. So therefore, once I've written my formula, I need now to work out figures so that I'm able to fit or substitute in my formula. So therefore, for the expected returns of X is given by probabilities. Probability times the expected returns. From this case, for X, you have been given probabilities there and also returns. For X, for A, B, C now, it will be 0.2 times its returns of 10 plus project B or economic status B, which is 0.3 times 15 plus 0.5 times 17. So when you work out that correctly, you are supposed to get the figure as 15% for X. Then expected returns of Y is still the probability, but now we multiply by different figures there for security Y, which is 18 plus 0.3 times 24 plus 0.5 times 26. So your answer is how much? Your answer there is 23.8%. So I have already the expected returns for X and expected returns for Y. So what is remaining is weights. Where do I get the weights? You have already been given from the equation. They are saying this particular project will cost 1,500,000 divided into 900 for X and 600 for Y. So those are the weights now. So our answer now there, we now substitute there. So our expected returns, our expected portfolio returns is now weight for X 900,000 divided by 1,500,000 times expected returns of 15 plus 600,000 divided by 1,500,000 times 23.8%. So if you work out that correctly, your answer you're supposed to get there is 18.52%. That is Roman 1. Roman 2, Roman 2 there is saying, calculate the expected what? Using the mathematical model, compute the portfolio risk. Portfolio risk. Which we have said it is what? It is the weighted what? It is the weighted standard deviation. This weighted standard deviation, how do you calculate standard deviation, class?